Hi, I'm Jerry Bowyer. You're watching the Eagle Investing Network, and I would respectfully ask that you hit the subscribe button. And I would also respectfully ask that you would share this video with other people who you think might benefit from learning about finance and economics, including people who might be interested in learning more about oil prices and what they tell us about the global economy and what they're telling us about the Ukraine-Russia war. And oil prices are involved probably in more ways than you imagine. All right, let's take a look at the data. This is oil prices per barrel from 1989 to basically now, as of the time of this recording. And this isn't adjusted or anything. It's not inflation adjusted. It's just high price, low price, way back then and now recently. Now I want to stop for a moment because a lot of people have talked about how oil prices are affected by the Ukraine-Russian war. But the thing is, I think the more interesting topic is how the Ukraine-Russian war is affected by oil prices, because most of the causality, I think the most important causality, is going in that direction. What do I mean? Let me show you. When we had this oil price spike, Russia invaded parts of Ukraine. When we had this extended time of high oil prices, Russia invaded other parts of Ukraine. When we had this spike here, Russia invaded Ukraine. Russia might have been a bear, but it was a hibernating bear at times like this. And basically, during this low time, except for a spike, what do we have here? The end of the Cold War. Russia loses global hegemony. So basically what it amounts to is this. When oil prices are high, Russia is rich. It can afford optional wars. When oil prices are low, it can't. So oil prices are a driver of geopolitical risk. Oil prices were already rising long before Putin invaded Ukraine. So here's a point I want to make about this. I don't try to do a lot of politics here, but when it's relevant, we're going to talk about it. Recently, President Biden suggested that Vladimir Putin was to blame for the recent spike in inflation. That's nonsense, because the inflation spike was before this war occurred. The inflation spike also was all areas, not just oil. Almost everything went up in price. And if the United States has good monetary policy and good energy policy, then we won't actually be able to have our prices controlled by a foreign conflict. Let's go back to the data. Now, I don't have all the data here. This particular data set didn't go back further. But oil prices during this period of time, and you can see they stayed pretty low after, during this period of time, Iran and Iraq were in an existential battle with one another. From 1980 to 1987, they were at war with one another. 7 of the 8 years that Ronald Reagan was president, they were at war with one another. But Ronald Reagan deregulated energy, and Paul Volcker beat the back of inflation by having monetary discipline, and that collapsed the oil prices. Foreigners, 2 oil powers, were trying to destroy one another, and American oil prices went down because they don't determine our inflation rate. We determine our inflation rate through our monetary policy. All right, let's go back to the data, and we're going to take take this line, turn it into individual dots, because that's what it is. These are different time periods. Then we're going to rearrange them, and so now they're not in time order, they're in price order. If you go back and review the video I did on copper, I'm not going to go through it again. We made some adjustments for past inflation and for the supply. We're trying to get at demand. And what we see is that there is a positive correlation. When the adjusted price is high, the next year global GDP growth tends to be high as well. So, it's not perfect. It's not every dot on the line, but clearly there is some kind of relationship going on here. That's the 12-month average. That's probably telling a little bit more of the truth, and that's showing a reasonable global recovery. Here's where we are now. I don't believe this number. I don't believe this number tells, I think it is telling us really 2 things. One is the global economy is recovering. The other thing is there is a geopolitical risk premium here with the Russia-Ukraine war, and the other thing is future inflation. People buy commodities to use them. In the case of oil, you use it as a lubricant and you use it as an energy source and you use it to make plastics, etc. So when the price of that goes up and that's reflecting demand, then that is a bullish sign for the industrial economy. But people also buy these commodities. People buy commodities in order to participate in the growth story, but they also buy commodities as a hedge against future inflation. Because really, prices of commodities going up is like almost the definition of inflation. I think today's oil prices have all that in it. Global recovery continues, not great like last year, but continues. Inflation expectations high out into the future, and of course the geopolitical risk in Russia invading Ukraine. So when you're investing in commodities like oil, you got to take into account the fact that you can't just look at one factor. There's a lot going on, and this spike in oil prices gives us some idea how many things are going on. One more thing, when oil gets up above say $110, $120 a barrel, that tends to be a recession signal. Oil went up a lot, and as of this recording, we actually had a negative quarter of growth. So at least a half a recession. So high oil prices plus some other stuff that's going on, rising interest rates are an indication that is a recession definitely going to happen? No, but the risks are rising, which is all the more reason for you to subscribe to the Eagle Investing channel so that you can keep up with all the latest on how to interpret this data and how to position yourself accordingly as an investor for a low growth, high inflation, geopolitically somewhat unstable environment. Thanks for watching.